You know that moment when you check your investment app and the number is lower than it was yesterday? Nothing dramatic happened. No crisis. No emergency. But something inside you tightens anyway. You close the app quickly, almost instinctively, not because you don't understand investing, but because the feeling is strangely uncomfortable. And later, when people talk about just hold for 20 years, it sounds simple in theory, logical even. Yet somehow your brain resists it. Quietly, most people interpret that reaction in a very specific way. They assume it means impatience, lack of discipline, a tendency to chase quick rewards. In finance circles, it's often framed as a character flaw, as if the people who struggle with long-term investing simply lack the willpower others seem to have. But that interpretation misses something important. Because what's happening in your mind during those moments isn't laziness, it's biology. The truth is, your brain wasn't designed for long-term investing, not because you're bad with money, but because the human nervous system evolved in a world where long-term meant something very different. For most of human history, survival operated on short feedback loops. If you gathered food, you ate that day. If danger appeared, you reacted immediately. If something caused pain, you avoided it next time. Your brain learned to prioritize outcomes that were visible, immediate, and emotionally clear. Modern investing quietly violates all three of those instincts. The rewards are distant, the feedback is inconsistent, and the path between action and outcome is often invisible. Psychologists call this temporal discounting. It's the tendency for the brain to value immediate rewards more than future ones, even when the future reward is objectively larger. But it's not just impatience. Neuroscience research shows that when people imagine rewards far in the future, the brain activates very different networks compared to immediate rewards. The future version of you is processed almost like another person. In other words, when you invest for 30 years from now, your brain doesn't fully experience that reward as belonging to you. It feels abstract, distant, almost theoretical. Meanwhile, the loss you see today feels extremely real. Even a small drop in your portfolio can trigger activity in the amygdala, the same threat detection system that once helped humans survive predators and environmental danger. Your brain doesn't interpret the market decline as a statistical fluctuation. It interprets it as potential loss. And loss, neurologically speaking, carries more emotional weight than gain. This is why a $100 loss often feels stronger than a $100 gain. Not because you're irrational, but because your nervous system is wired to prioritize protection over patience, and that wiring usually begins much earlier than people realize. Our relationship with uncertainty, delayed rewards, and financial risk often forms through repeated experiences. Some people grow up in environments where resources feel stable and predictable. Waiting for something better later feels safe. Others grow up in environments where outcomes are less certain, where opportunities appear and disappear quickly. In those situations, prioritizing the present isn't a flaw, it's a survival strategy. Your brain learns that what exists today is more reliable than what might exist tomorrow, and that pattern can quietly follow you into adulthood, even in environments where long-term investing makes logical sense. None of this means one mindset is better than the other. Some people naturally tolerate delayed rewards. Others naturally scan for immediate feedback and risk. Both tendencies have advantages in different environments. History is filled with people who succeeded because they acted quickly, and others who succeeded because they waited patiently. Different nervous systems solve problems in different ways. But here's the quiet paradox inside long-term investing. The very traits that make someone cautious about waiting often come from a brain that is highly attuned to risk. That same sensitivity can make someone incredibly thoughtful about protecting resources, avoiding major mistakes, and adapting quickly when circumstances change. In other words, the resistance you sometimes feel toward long-time minds isn't necessarily weakness, it's awareness. The challenge isn't eliminating that instinct, it's learning how to work with it. Because long-term investing asks the brain to tolerate something it naturally dislikes: uncertainty, combined with delayed reward. And doing that consistently isn't just a financial skill, it's an emotional one. So if you've ever felt that quiet tension when markets drop, or wondered why holding investments for decades feels harder than people make it sound, there's nothing wrong with you. Your brain is simply responding the way human brains have been trained to respond for thousands of years. And once you see that clearly, something interesting happens. The struggle stops feeling like a personal failure and starts looking like a design challenge. one that becomes easier to navigate the moment you understand what your mind is actually trying to protect. And there's another subtle pattern hidden inside this relationship between money and the brain, one that explains why even intelligent, disciplined people make financial decisions they later struggle to explain. If you look closely, you might recognize that pattern in yourself too.